Hey guys, this is Trading Bruce with a quick breakdown on Vol Crush and why it matters to you, or why it should matter to you. Now, I get questions all the time about volatility and how does it work. We know it greatly affects option pricing, but we're right in the middle of earnings season, and this is very, very important. It comes up all the time right now. So I've got a really good example here in Google that I wanted to share with you guys very quickly. So let's jump right in. All right, we've got Google up here. Now Google reports today after the close. I'm filming this on February 4th. They report after the close, and I was looking at it in my live trading room. We set up a run into earnings trade here. I actually did a video on that one. And caught a lot of this move up here in a butterfly, and thinking about doing another trade. So this would be the second in a series of trades that you can get around any earnings event. You can get the run into earnings, you can get the trade on the earnings event itself, and then after that you get a different type trade because of the vol crush, and I'm going to show you how all that works. So again, they're going to report today after the close. I did a screenshot last night when I was looking at this. Let me pull it over here to show you guys. Well, I'll start here. Now, right down here, this is implied volatility. This is very important to option pricing across the board on every stock, ETF, whatever that's traded. And you can see that it goes up and down, up and down, up and down, up and down. Why is that? Because of the unknown, right? We have a big unknown event coming up out here, which is earnings, right? Are they going to be good? They're going to be bad? They're going to miss? They're going to crush it? What's going to happen? Because of that unknown, the tension gets built up in the options, which makes the price go higher. People are trading more options around it. Some are hedging, buying puts, some are buying calls because they think it's going to go up, which makes the volatility increase. And let me show you how we can kind of track that. Now I've got, let's see here, I'm going to load my earnings analysis here. Now I've got this kind of a custom one made. You can get this off the internet, I think on Yahoo or Yahoo Finance or any of this stuff like that. I can help you with that if you need some help, let me know. But this is what I want to focus on. Average pre-earnings IV. So before the earnings event, the average, going back, this is a 1 year chart. Going back 1 year is 34.56%. Currently, we're at 44. Right? See that down there? And I'll kind of zoom in a little bit more. 44.3 right here compared to 34. So that implies, or that actually it literally means, that there's more anticipation of a bigger move than normal over this earnings event, which is again today after the close. Now, maybe it's more, maybe it's less. You can see here we've had 3 gap up, and where's one gap down? So that's down, that's up, up, up. So on the surface, I would take that as bullish. But let's look a little deeper here. Let me flip this back over. I like to keep things simple. Let's just go to simple moving averages here. And let's go to the trade tab of Google, and I'll show you what I mean. So if we look at, this is the option chain, and this is what I was going to show you. So I printed this off last night when I was trying to set up, get a trade ready for today. And notice 6 Feb last night, the implied volatility was 89%. Look at it now, it's 103. It's going up, 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 up because tension, tension. What's going to happen? What's going to happen, right? And to get another perspective, I did this morning after the market opened. I don't have a timestamp on here, but it was about 96%. And again, now it's 103, so it's going higher, higher, higher. Now this, 100% vol, that's kind of crazy. Now it can go even, a lot higher than that. It doesn't have to stop at 100%. But I just wanted to show you guys that it will change. So why does that matter? So we're going to get in. That's volatility now. It's vol crush. What happens and why does that matter? Or why should that matter to you? So this 103% right here is for the entire series, meaning all of the options, puts, calls, all that kind of stuff, right? So if we look over here, you see our implied vol. and you can see it's 103, 102. Now that's for each strike. If you wanted the 330 strike, that would be 103.36, or the 330 call would be 104.06, which means that particular option, if you were to buy or sell that, you're paying a big premium built in because that price is up. Now it kind of goes back to, they say buy the rumors, sell the news. Once the earnings is released and we know what that number is, and they crushed it or they missed it, all of this built up, pent up demand, I guess, in the options is going to come out instantly, right? So what that means is the price of these options will drop. And how you know that, or how you can see that, let's flip this over to intrinsic and extrinsic value. All right, so intrinsic value is what the option is literally worth, right? That's the book value, basically. But the extrinsic value is in most cases, it's essentially time value on an option, right? So notice, if you bought that 335 call, there is $10 of extra. It's almost all extrinsic value, which, guess what? When the earnings are released today, well, tomorrow this will drop wildly. It'll drop, that $10 extrinsic will go to $5. Well, I'm assuming if it goes down. If it goes up, that actually could go from 10. It will still drop some, but it won't give you the bang for the buck that you thought. And this is where the question comes to me all the time. Bruce, I bought calls on Google and they crushed it and I still lost money, right? Well, that's why, because you're buying inflated prices. You're paying, super retail prices for these options, and they will deflate. So what that means is so the puts, here's the puts, there's the calls. If you're on the put side and they crush it and it goes up, these are going to evaporate. They'll be worthless instantly, right? And let me show you what that looks like on a larger scale so you'll see what I'm talking about. Let's go, I'll put this on a 2-year chart. It's a little bit easier to see. So if we go back and look, each time, I've got my drawing tool on this screen is the reason I keep looking over there. Each time there's an earnings event, the volatility goes up, and guess what happens? They announce and vol crush, and it goes up and vol crush, and it goes up and vol crush, and up and crush, and up. Here it's much higher. That's because Google was coming down. That's because the overall market in 2025 was coming down. Again, come up into earnings, crush, come up into earnings. Look at that vertical line, straight down, crush. So what's going to happen tomorrow? They're going to come up here and it's going to crush straight down. Again, the reason that matters is because it's going to dramatically affect the pricing of your options. Let me show you another couple of examples here. Let's just look at Amazon. And it's almost like an EKG. Look at this. Straight up, straight down, straight up, straight down, straight up, straight down. Every time. That will happen. You do not escape a vol crush. It will happen, right? And there could be other reasons for vol crush, merger, potential merger that doesn't happen, or something like that. Political, all that stuff, kind of stuff can happen too. One more. Restoration Hardware always does have a pretty wild, I don't know why, I've traded it for years. It's always got a pretty predictable vol crush. And again, the more predictable that these vol crushes are, you want to buy down here as that vol is increasing. If you're buying options, you want to sell up here before that crush comes. Sell here when the crush comes. Sell when the crush comes, right? And you can do that through selling put credit spreads primarily, iron condors, things like that. Again, there's always 3, and I should do a video on this. I will. I'll do a video on the 3 different type trades around an earnings event that you can do, and they're very different trades based on primarily what the volatility is doing. I mean, of course, we want to get the direction right, but we want to know, also what the volatility is doing. So let me show you an example. Last night, I pulled up a straddle. Is where you can always tell. If you go to, say, Google, and this is for Friday, 6 Feb, if you add the cost of the puts and the calls, so you can see it's about $10 on this side, about $11 on this side. So it's about a $21 total price if you were to buy puts and buy calls, right? Well, guess what the market maker move? MMM is market maker move, about $21. That's what they're pricing in for a move on this. So last night I'm looking for a trade, and I looked at this and I said, okay, a straddle here was going for $21 last night. And I showed you the screenshots of the actual trade tab that I did. And guess what? Because remember the first one I showed you from last night, I think that vol was like 86 and now it's 103. Well, this thing has gone up $1,000 in value. If we put this on yesterday before the close, we could take it off right now and make $1,000, right? If then that because vol is going up, we bought in this scenario. The green is where we bought options. If we sold options, guess what? We're down about $1,000. Why is that? Well, you sold the option at an 86 vol and it goes up to 103 or whatever. People don't want the 86 vol when they can get 102 vol, 103 vol, whatever. So it makes the price of yours essentially go down. I'm giving you, this is ballpark conversation we're having here, right? But anyway, that's basically how it works. So how do you offset something like that? And I'll wind it up in a second, but how do you offset something like that? Well, be very careful holding things over the actual event, because again, we know this is going to happen. It happens every time. Look at that. It will happen, right? That's restoration horror. But on Google, it's going to do the same thing. It always has and always will. I've been doing this for 35 years. It's always been that way, right? I've been trading professionally for 35 years. So how do we offset something like that? I'm really bullish. I want to do something on Google. How do I avoid a vol crush? One, either get out before the earnings, and that's a perfectly fine way to do it. Or in this case, let's do some quick math. We got a $21 expected move. That gets us to about 350. Let's just say, what if we bought a debit spread here and we did a let's just make it interesting, a 347, 350. So check this out. In this scenario, we're buying the 347 and we are selling the 350. So we're buying something that costs $5 and we're selling something that costs $4.30. So that offsets it. Let me show you. It's a little bit better to see when you can see it in percentages. So if we're going to buy a 102 vol, we know that's going to cost us about $5. If we're going to pay 102%, but look, we get 101% back when we sell this against that, right? So that's the spread. It cost about 75 cents. And I set this up earlier. So if we were to do this, it's actually kind of interesting. So that would cost you about $700 on a 10 lot. If we do crush it and they go up here to 350, it's worth about $1,800. That's not bad. We do know this will crush, and what I mean by that, even though those are basically offsetting each other, this pink lavender T+1 line, if we go higher tomorrow based on the earnings, this is going to come up and this is going to come down on this side. So you got to get over into the body of this thing for it to work. That's another discussion for another video, but I want to show you the point and how you can kind of get around that. The main thing is be aware of how volatility affects your trades. Are you buying options or are you selling options? Because if you're buying options, you're paying top dollar for those options, and they better really move, right? If you're selling them at tip-top prices, which is great. That's what you want to do. But you better make sure your direction, right? Don't sell a call credit spread. Don't sell a call credit spread up here like that, and Google crushes it and goes ripping through it, right? You got to be careful. Or iron condor might be another way to do it as well. So, and that in stay between, and you're fine, and you kind of get the best of both worlds. But again, that's a conversation for another day, another video. In fact, I'm doing a whole series for you guys. I've had a lot of people ask me to do a series on, I've got one on intrinsic, extrinsic value, and a lot of the stuff on the trade tab here. Very, very helpful. Be sure and subscribe to the channel, which will alert you when I post that stuff. I should have it ready in the next week, maybe even this week. I don't know. I'm going to do 10 different videos, and I've got about 7 of them completed already. So I'll have them done as soon as I can. Or you can join me in the trading room at Simpler Trading. I run a separate trading room there. We do this stuff every day, all day. So that is what I've got. Again, let's keep an eye on Google tonight and see what they do after the close today. And again, look at the chart tomorrow and you will see this probably come up a little bit more, and then it's going to drop straight down just like that, just like that, and just like that, and just like that. And it's always cool to watch. Again, you can use that to your advantage. If you don't know something, then you can get your head chopped off. If you know what happens, then you can get on the other side and prepare and take advantage of it, right? And that's what I'm here to do, is help you guys. So with that, let me wind it up. Thanks for the time. I appreciate it. Come join me in the trading room. Of course, like and subscribe this video and subscribe to the channel, and you'll see those classes, or they're free, the videos I should say. They're going to come out highlighting how to check intrinsic extrinsic value, along with a whole lot of other stuff that's going to be very, very helpful. It'll really help you out. So again, check that out. So thanks for the time, guys. I appreciate it, and let's see what happens with earnings. Thanks. Take care.